Before we dive into today's interesting topic, let's get something very crucial out of the way. It's essential to conduct personal research before making any financial decisions. This video is packed with information, but it's not intended as financial advice. Remember, we are not financial advisors and you should always do your own research. Now that we've set the stage, let's talk about two popular investment options: stocks and cryptocurrency. Stocks represent a portion of ownership in a company. When you buy a stock, you're essentially buying a piece of that company, sharing in its profits and losses. Stocks have been around for centuries, and they are traded on regulated exchanges. On the other hand, cryptocurrency is a digital or virtual currency that uses cryptography for security. Launched with Bitcoin in the year 2009, cryptocurrencies are relatively new players in the investment game. They operate on technology called blockchain, which is a decentralized system spread across many computers. Cryptocurrencies are usually bought and sold on various online platforms. While stocks and cryptocurrencies share the common goal of providing financial returns, their mechanisms are fundamentally different. Understanding these two options is the first step towards making informed investment decisions. First on our list is stocks. What are the risks involved in investing in stocks? Let's delve into that. Stocks, essentially, are shares of ownership in a company. When you purchase stocks, you're buying a piece of that company, betting on its future success. However, this investment comes with its fair share of risks. One of the primary risks in stock investing is market volatility. The stock market is known to fluctuate, sometimes drastically, driven by various factors such as economic trends, political events, and even societal mood swings. One day your stocks could be riding high, and the next, they could plummet. This unpredictability can be a bit of a roller coaster ride, especially for novice investors. Another risk stems from economic factors. Things like inflation, interest rate changes, and shifts in the job market can all impact the performance of stocks. For instance, an increase in interest rates can make borrowing more costly for companies, potentially hurting their profits and consequently, their stock prices. Then we have company performance. This is a big one. If the company you've invested in performs well, your stocks could soar. On the flip side, if the company underperforms or worse, goes bankrupt, you stand to lose your investment. This risk underscores the importance of researching and understanding the company you're investing in. Let's not forget about other potential risks. These could range from changes in industry regulations to unexpected events like natural disasters, which could impact a company's operations and profits. However, it's important to remember that risk is intrinsic to any form of investment. It's part and parcel of the game. The key is to understand these risks, take informed decisions, and manage your investments wisely. In the end, while the risks of investing in stocks are real and can be intimidating, they should not deter you from considering this investment option. After all, with higher risk often comes higher potential for reward. But it's not all doom and gloom. Stocks also come with their fair share of rewards. Now that we've looked at the risks, let's shine some light on the potential rewards of investing in stocks. The first reward that comes to mind is dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, usually on a quarterly basis. It's like a regular paycheck just for owning a piece of the company. Another key reward is capital gains. This is the profit you make if you sell your stock for more than you paid for it. The beauty of capital gains is that they can significantly outpace inflation, helping your money grow over time. Lastly, let's not forget the potential for long-term growth. Stocks of well-established companies tend to grow steadily over time. And even though there are ups and downs, the overall trajectory has historically been upwards. As you can see, stocks have a balanced risk-reward ratio. But what about cryptocurrency? Moving on to our second investment option, cryptocurrency. How risky is it to invest in digital currencies? Cryptocurrencies, the digital currencies that have taken the world by storm, offer an alternative way to invest. But like any investment, they come with their own set of risks. Let's delve into what those might be. Firstly, cryptocurrencies are known for their volatility. The value of cryptocurrencies can swing wildly, sometimes in just a matter of hours or even minutes. This means that you could experience significant gains, but also substantial losses. Remember the Bitcoin boom of late 2017, when its value skyrocketed, only to come crashing down a few months later? That's volatility for you. Secondly, regulatory risks. Cryptocurrencies operate in a legal gray area in many parts of the world. Governments are still trying to figure out how to regulate these digital assets. This could mean that laws and regulations could change rapidly and unpredictably, potentially impacting your investments. Next up, security issues. Cryptocurrencies are stored in digital wallets, which can be vulnerable to hacking. And unlike traditional banking, there's no insurance to cover you if your digital wallet gets hacked. Moreover, if you lose access to your digital wallet, say you forget your password or lose your private key, there's no way to recover your investment. Lastly, the risk of market manipulation. With no oversight or regulation, it's possible for individuals or groups to manipulate the market. This could lead to artificial inflation of prices, followed by a sharp drop, a phenomenon known as a pump and dump. So in conclusion, investing in cryptocurrencies can be a bit like riding a roller coaster. It's thrilling, sure, but it's also unpredictable and could leave you feeling a bit queasy. But remember, with great risk can come great reward. And that's what makes investing, whether in stocks or cryptocurrencies, exciting. Cryptocurrencies can be a risky investment, but they also have the potential for high rewards. Despite the risks, many are drawn to cryptocurrencies for their potential rewards. Let's explore why. Cryptocurrencies, unlike traditional investments, present a unique advantage: their high returns. In the past, we've seen cryptocurrencies such as Bitcoin skyrocket in value over a short period. This kind of rapid growth is unheard of in traditional stock markets, making it an attractive proposition for the risk-takers among us. Another reward of investing in cryptocurrencies is their decentralization. This means they aren't controlled by any government or institution. Transactions are transparent, and the power is in the hands of the people, you and me. Lastly, cryptocurrencies are still in their early stages of development. This opens up a world of potential for growth. As more people and businesses start to adopt cryptocurrencies, their value could increase even further. Cryptocurrencies offer a high-risk, high-reward investment option. But is it right for you? So, we've covered a lot of ground today, comparing the risk and rewards of stocks and cryptocurrencies. We started off by laying the groundwork, explaining the basics of stocks and cryptocurrencies. We understood that stocks represent ownership in a company, while cryptocurrencies are digital or virtual currencies that use cryptography for security. We then delved into the risk factor associated with stocks. We discussed that the value of stocks is tied to the company's performance, and hence, it is susceptible to market fluctuations, economic downturns, and poor management decisions. However, we also pointed out that stocks have a long history of providing a reliable return on investment over the long term. Next, we looked at the rewards in stocks. We highlighted that apart from potential capital gains, stocks can also provide dividends, which are a share of the company's profits distributed to shareholders. We also mentioned that investing in stocks allows for diversification, which can help manage risk. Switching gears, we then focused on the risk in cryptocurrencies. We learned that the value of cryptocurrencies can be highly volatile, with prices capable of swinging wildly in a short time. We also touched on the regulatory risks, technological risks, and the risk of loss from hacking or fraud. On the flip side, we explored the rewards in cryptocurrencies. We underscored that cryptocurrencies offer the potential for significant returns, with some coins having shown exponential growth. We also emphasized the allure of decentralization, where cryptocurrencies are not controlled by any government or central authority. So, what's the bottom line? Both stocks and cryptocurrencies have their own sets of risks and rewards. Stocks offer a more stable, long-term investment, while cryptocurrencies provide the possibility of high returns but with greater volatility. It's all about understanding your risk tolerance, financial goals, and doing your due diligence. Remember, we're not financial advisors. It's crucial to do your own research and consider seeking advice from a qualified professional before making any decisions. Thanks for watching. Be sure to like, comment, and subscribe. And hit the bell notification so you'll get updates anytime we upload a new video.